Futures in the green and yield lower across the board after the latest reading on inflation. The producer price index rising less than expected last month. Now investors are growing more confident of a Fed rate cut next month. Over 55% of traders now betting on a 50 basis point rate cut in September. That rose about 4% after the print. Here to discuss what this means for the broader markets and where we could go from here, we want to bring in John Stoltzfus. He is Oppenheimer's chief investment strategist. John, it's great to see you. So a perfect time to talk to you. We've got a number of key inflation prints obviously hitting the markets here. You've got PPI this morning. You've got CPI tomorrow. I'm curious, now that the markets seem to be pricing good news for the economy is good news here for the markets, I'm curious what your view is of this inflation print and ultimately what that signals for tomorrow.
Well, great to be on Yahoo Finance, Shauna. Got to say, when we look at this, it's positive for equities. It releases some of the dark sentiment that had gripped it over the course of the start of this month. We can't help but think that this gives the Federal Reserve opportunity to begin cutting rates. We think it'll be a 25 bips rate now in September, with likely another 25 after the election. Whether they do another one in December, I'm not sure, but we think it'll be September and November. We've been looking for a long time for the second half of the year to be 2 cuts, but we had thought after the election, but these numbers look good. They suggest that the Fed should get cracking when it comes to dealing with rates where they are. Put a down payment towards for both Main Street and for Wall Street in terms of where the direction is in terms of rates.
John, we've heard turbulence for the stock market become a much more frequently used word over these past couple of weeks now. How much of that turbulence is now attributed to what you were mentioning in people thinking the Fed has waited too long at this juncture, and what type of turbulence should they be bracing for?
Well, Brett, I've got to say that when it comes to turbulence is always potential for the market. You've got to expect that any time bears, skeptics, or nervous investors sense that there's a catalyst out there to take some profits amidst the bull market, without FOMO, they're going to take it. And everybody jumps on the drama. For intermediate to long-term investors, usually a good opportunity to look for babies that get thrown out with the bathwater. Really good stock that may have been a little bit too expensive before, now looking more affordable in here. Opportunity to further diversify portfolios. And then, of course, for the bears and the traders, the short-term folks, it's an opportunity to trade the bips and see what they can put in the cup, so to speak.
John, what should we be expecting on the volatility front? And I ask that now that we have earnings season winding down, a lot of that the driving force maybe that's expected to be behind the market is going to be dependent on these type of econ data prints. It's going to be dependent on what we're hearing from Fed officials. So how much more volatility do you expect that to then introduce here to the markets, given the fact that we are in this place of uncertainty right now?
Shauna, not a heck of a lot more than we've had, but always a potential for it on any tidbit of information, whether it's a data point or something related to even perhaps towards the presidential election that could cause some anxiety. But we'd have to say really not abnormal for this type of period. We're in a transition period right now. We're beginning to, it would appear to us that the Fed has already said, not just intimated, but it wants to cut rates. So we're towards the end of a Fed funds hike cycle. And the important thing is that we get an idea that the economy is not in a recession or moving towards a recession, but rather it's the end of a Fed funds hike cycle because enough is enough. We're normalized rates. Once again, bond issuers have to pay for the privilege of borrowing money, but maybe they can get it a little bit cheaper than what they've seen at the peak of this Fed funds hike cycle. And all in all, entering a new phase for the economy that is sustainable growth that will help the Fed meet its double mandate, which is essentially an economy that grows enough so that you don't have, but one that doesn't have too much inflation, but at the same time provides opportunity for full employment, which is somewhere around 3 to 4%, a little bit over 4% perhaps unemployment to allow for transitions and changes in the job market.
So, John, just as we're continuing to kind of navigate our second half playbook here for the rest of the year, you're talking about the conclusion of the high cycle, a growth without an economic growth without exorbitant inflation. You've also got the election risk that you mentioned a moment ago. What is the largest catalyst that you think is going to drive the market in the back half of this year from this point forward?
I'd have to think, Brad, what you really need to see here is continued resilience in earnings. You know, when we look at the earnings season for this particular second quarter earnings season, which is almost over for the S&P 500, you've got earnings growth over 9%, revenue growth over 4%. And what it says is there's resilience. Yeah, the pace of earnings growth is slowing somewhat, but you still have 5 sectors with double-digit earnings growth, and you've got only 2 sectors, last I looked, with negative earnings growth. This is a good thing. And so always, what's the market looking for? It's looking for a Federal Reserve that shows some sort of sensitivity to where inflation is, as well as it's looking for an opportunity to see revenue and earnings growth. That's what it's all about.
John, thanks so much for joining us here ahead of the opening bell this morning. We got to leave things there for today. John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. Good to see you, John.
Thanks.